What if I told you that the way most people try to grow their money is completely backward? That the tricks we retaught in school about saving and investing could be costing you decades of wealth? And there's a little-known secret that the richest people quietly exploit to make money while they sleep. Today, we're uncovering the truth about mutual funds, one of the most powerful, yet misunderstood financial tools in the world. By the end of this video, you'll understand not only how they work, but why they have quietly shaped the fortunes of millions, and how you can leverage them to create true passive income. Mutual funds weren't invented yesterday. In fact, their history stretches back almost a century, to a time when investing was reserved for the wealthy elite. In the 1920s, Wall Street was a gambling ground. Stocks soared, fortunes were made overnight, and then, just as quickly, they were wiped out. Ordinary investors had no real access to diversified opportunities. They were either too rich, too risk, or too poor to play. The system was designed to favor insiders. But in 1924, a Dutch-born businessman named Adrian van Ketewich changed the game. He created a fund that pooled money from multiple investors to buy a diversified portfolio of bonds. This was revolutionary. It allowed ordinary people to invest without having to pick individual stocks, spreading risk while still having a stake in the market. This simple idea, pooling funds, would evolve over decades, survive multiple crashes, and eventually become a cornerstone of modern investing. Fast forward to the United States in the 1930s and 1940s, the Great Depression had just shattered the global economy, wiping out savings and trust in banks, and investors were terrified. How could anyone make money safely again? Enter mutual funds. Companies like Massachusetts Investors Trust started offering shares that gave people exposure to a broad basket of stocks and bonds, reducing risk compared to buying single companies. The promise was simple. A professional manager would make the decisions, and investors could set it and forget it. By the 1950s and 60s, mutual funds were no longer a niche product for the wealthy. They were marketed to middle-class Americans as a way to achieve financial freedom, a way to grow wealth without constantly watching the market. Advertising campaigns promised something almost magical: steady, reliable growth, and people believed it, because for a time it worked. But before we go further, let's pause and break down how mutual funds actually work. The engine behind this passive income machine. 1. Pooling investor money. Imagine a giant pot where hundreds, or even thousands, of people contribute money. This pooled fund is then used to buy stocks, bonds, or other assets. Instead of owning a single stock, you own a fraction of a diversified portfolio. 2. Professional management. A fund manager, who studies markets and companies, makes the investment decisions. This is where the expertise comes in and why people pay management fees. 3. Diversification. Diversification spreads risk. If one stock fails, the losses are cushioned by the other investments. It's like not putting all your eggs in one basket, a simple principle with profound effects over time. 4. Liquidity. Most mutual funds allow you to buy or sell shares daily. You're not locked in forever, unlike real estate or private businesses. Cut to animation showing money flowing from investors gives diversified assets, gives returns flowing back to investors. Sounds simple, right? But the story of mutual funds isn't just about safety. It's about power, timing, and a subtle system that can make or break fortunes. Mutual funds didn't always work perfectly. Their history is riddled with shocks that reveal a hidden truth. Even a safe investment carries risk. Take 1962, the infamous flash crash, when the Dow plunged nearly 5% in a single day. Investors panicked, many pulling out of funds. Managers were forced to sell assets to meet redemptions, amplifying losses. Or consider 2008, the global financial crisis, when some bond funds faced mass withdrawals because they held mortgage-backed securities tied to collapsing real estate. People thought mutual funds were risk-free. They weren't. These crises forced regulators to rethink rules around liquidity, transparency, and risk management. Mutual funds evolved, introducing stress tests, redemption limits, and improved reporting. Yet the lessons remain. Timing, fees, and fund composition can make the difference between wealth and loss. Fast forward to today, and mutual funds are a $50 trillion global industry. They are the backbone of retirement accounts, 401ks, and pension funds. Almost every middle-class investor has at least some exposure, often without realizing it. But here's the twist. The strategies of yesterday are repeating today in new forms: index funds, ETFs, target date funds, all variations of the same principle. Adrian Van Ketwich started nearly a century ago. And the data is shocking, according to recent reports. Nearly 70% of Americans rely on mutual funds for retirement savings, yet only 30% fully understand how they work. This gap between massive adoption and low understanding is the secret that creates both opportunity and danger. Those who understand the rules and timing can compound wealth steadily. Those who blindly follow can be left chasing returns they don't fully grasp. Mutual funds make money in three main ways. Understanding each is key to mastering passive income. 1. Dividends. Many mutual funds invest in dividend-paying stocks. These dividends are periodic payments companies make to shareholders. When you invest in a dividend-focused fund, those payments flow back into the fund, which can either be reinvested or paid out to you as cash. 2. Interest income. Bond funds generate interest. Companies and governments borrow money by issuing bonds, and the interest they pay is distributed to investors in the fund. Over time, this steady income can form a reliable, passive cash flow. 3. Capital gains. When the fund sells an asset for more than it paid, the profit is distributed to investors. These are called capital gains. Unlike a single stock, mutual funds diversify holdings, so gains come from multiple sources, smoothing out volatility. Put together, these three streams allow a properly managed fund to grow your wealth over time, often without requiring you to touch your money. Here's where the real secret lies: compounding. Albert Einstein allegedly called it the eighth wonder of the world. Compounding means your earnings generate earnings. In mutual funds, reinvesting dividends and capital gains accelerates growth exponentially over time. Let's look at a simple example. Imagine you invest $10,000 in a mutual fund that earns 8% per year. And if you add just $200 per month, the effect is staggering. Tens of thousands of dollars can grow into millions over decades. This is why time in the market is far more important than timing the market. Mutual funds have evolved far beyond the original concept. Today, investors have a range of strategies depending on goals and risk tolerance. 1. Index funds. These track a market index like the S&P 500. They offer broad diversification, low fees, and historically strong long-term growth. For many, index funds are the foundation of passive investing. 2. Target date funds. These adjust the mix of stocks and bonds automatically as you approach retirement. They're designed to reduce risk over time, letting you set it and forget. Here's what most people don't realize. Mutual funds have shown a repeating pattern for decades. Historically, 70 to 80% of top-performing funds this year do not repeat their performance next year. Yet new investors chase these winners every cycle, falling for the same trap over and over. Meanwhile, low-cost index funds, largely ignored by trend chasers, consistently outperform most actively managed funds over the long term. The market punishes impulsive behavior and rewards patience. Patterns repeat, history teaches, but human behavior rarely adapts. 3 clear takeaways. So, after uncovering the mechanics, history, and modern strategies, here are 3 crucial takeaways for building passive income with mutual funds. 1. Start early, stay consistent. Time and regular contributions are your greatest allies. Even small amounts grow exponentially if you remain invested. 2. Choose low-cost, diversified funds. Fees and concentration risks silently drain wealth. Stick to broad, diversified, and low-cost options for steady growth. 3. Reinvest. Don't panic. Let your earnings compound. Avoid selling in fear or chasing the next hot fund. Discipline creates true financial freedom. Mutual funds are powerful, but they are not magic. Ignoring fees, selling in panic, or chasing trends can turn even the most stable fund into a trap. Passive income requires understanding, patience, and strategy. Are you using time and compounding to your advantage, or are you leaving your money on the table? And if you found this video eye-opening, hit that like button and subscribe for more in-depth guides on building wealth the smart way. Comment below, are you currently investing in mutual funds, or just thinking about it? Share your experience, and let's unlock financial freedom together.